There is a fascinating paradox unfolding in the economy right now, a mathematical contradiction that mainstream media is largely misinterpreting. On paper, the system tells us everything is holding together. Unemployment remains historically low at around 4.3%, and government reports point to continued consumer spending. Yet, consumer sentiment has violently plummeted by 11% in a matter of weeks, crashing to a score of 47.6. To put that number into perspective, that is the lowest level recorded in the post-World War II era. It is a bleaker reading than what we saw during the darkest days of the Great Recession in 2008, and it is worse than the absolute bottom of the recent global pandemic downturn. How is it mathematically possible that people are employed, yet they feel poorer and more pessimistic than they did during the worst financial collapses of the modern era? The financial media will tell you it is just a temporary psychological reaction to the news cycle. Financial advisors will tell you to ignore the noise and keep blindly buying their financial products. But today, we are going to look at the cold, hard numbers. We are going to decode the domino effect of geopolitical conflicts, energy shocks, and inflation. And I will show you exactly how global supply chain disruptions are quietly draining your bank account, while Wall Street hopes you do not notice. To truly understand this macroeconomic shift, we have to stop looking at national averages and start looking at personal balance sheets. Let us look at a representative character, someone we will call David. David is a professional, making $75,000 a year. He has a solid credit score of 720. He budgets, he pays his bills on time, and he represents the backbone of the consumer economy. On paper, David is a success story of the current labor market. But let us look at the actual math of his daily life in the current macroeconomic environment. After taxes and basic deductions, David brings home roughly $4,500 a month. Over the past few years, he has already absorbed massive increases in his baseline survival costs, from rent to groceries. But right now, a new invisible tax is aggressively attacking his remaining disposable income. Due to ongoing geopolitical conflicts, global energy markets are fracturing. The cost of crude oil and refined products like gas and diesel are surging, and energy is the master resource. It is the cost that drives all other costs. When the consumer price index surges by 0.9% in a single month, pushing the annual rate to 3.3%, the media often reports it as a minor fluctuation. But for David, a 0.9% monthly spike is a financial earthquake, because that inflation is not distributed evenly. It is hyper-concentrated in the things he cannot avoid buying. The cost to fill his gas tank surges. The cost of diesel surges, which instantly translates to higher prices for every single item delivered by a truck to his local grocery store. The cost of airfare spikes. David's fixed income of $4,500 a month is suddenly buying 10 to 15% less physical goods and services than it did just a short time ago. The system has not lowered his salary, but it has drastically lowered the purchasing power of his currency. This is the root cause of the plummeting consumer sentiment. It is not an emotional overreaction. It is a highly rational, mathematical recognition by the American household that their standard of living is actively declining despite their employment status. This financial struggle is not David's personal failure. It is a structural fracture in the economy. What the major financial institutions and the government do not want to heavily publicize is the dangerous shift in inflation expectations. Recent survey data shows that consumer expectations for inflation in the year ahead have violently surged a full percentage point to 4.8%. This is the largest monthly increase we have seen in a long time. Over the long term, spanning the next 5 to 10 years, expectations have also climbed to 3.4%. Why does this hidden data matter so much? Because in macroeconomics, inflation expectations often become self-fulfilling prophecies. When consumers like David believe that their money will lose nearly 5% of its value over the next 12 months, it alters their behavior. It forces them to make impossible choices. They either pull back completely on discretionary spending, which starves the broader economy of the capital it needs to grow, or they are forced to take on high-interest credit card debt just to maintain their current lifestyle. This brings us to the domino effect that is currently playing out. The US economy is fundamentally a consumer-driven engine. Consumer spending accounts for roughly 2/3 of the entire economic output. Right now, economists are observing a terrifying game of chicken. Consumers are incredibly pessimistic, yet the spending data shows they have not completely closed their wallets yet. The institutional narrative is that this proves the economy's resilience, but the underlying mathematics tell a different story. Consumers are not spending from a position of strength, they are spending from a position of necessity, often leveraging debt to bridge the gap between their stagnant wages and soaring energy and food costs. Companies are currently holding on to their workers, keeping the unemployment rate low at 4.3%. But corporate profit margins are under immense pressure from these exact same supply chain shocks and sweeping trade tariffs. The first domino is the geopolitical conflict disrupting energy. The second domino is the sudden spike in the consumer price index and production costs. The third domino is the aggressive decline in consumer sentiment and the rise of inflation expectations. The final domino, the one currently teetering on the edge, is corporate layoffs. Once businesses can no longer pass the increased costs of diesel, tariffs, and raw materials onto the exhausted consumer, their profits will compress. When profits compress, the historically low unemployment rate will inevitably break. And once job losses begin to accelerate in an environment where consumer sentiment is already worse than the 2008 financial crisis, the pullback in spending will be violent, potentially triggering a deep structural recession. This is the reality of the macroeconomic landscape. Your financial struggle is not a reflection of your personal failure to budget. It is the direct mathematical result of a fragile, heavily financialized global supply chain that transfers the cost of conflict directly onto the shoulders of the working class. So, how do we navigate this environment? We must abandon emotional reactions and rely entirely on mathematical defense. You cannot control global conflicts, but you can control your capital allocation. Strategy number 1 is to aggressively calculate and defend your personal inflation rate. The official government inflation rate of 3.3% is irrelevant to you if your personal cost of living is rising by 8% due to your commute and your specific consumption habits. You must conduct a ruthless audit of your monthly cash flow and eliminate discretionary spending that is heavily dependent on energy and complex supply chains. This is not about living in fear. It is about building a fortress around your liquidity. In an environment where the labor market is flashing warning signs, cash flow is your absolute highest priority. Strategy number 2 is to mathematically position your capital to absorb the inflation tax. If the market expects inflation to run at nearly 5%, leaving your emergency fund or surplus capital in a traditional savings account yielding a fraction of a percent is mathematically guaranteeing a loss of purchasing power. You must seek out high-yield cash equivalents, short-term treasury bills, or inflation-protected securities that offer a yield closely matching or exceeding the real rate of inflation. Furthermore, in times of prolonged supply chain disruptions and geopolitical instability, capital tends to flow toward hard assets and commodities. While the mainstream media pushes you toward broad, speculative index funds blindly, a rational investor must look at the sectors actually benefiting from the current structural shifts. Understand that volatility is not your enemy. Ignorance of the data is your enemy. The numbers do not lie, but the way they are presented to you often obscures the truth. We are living through a profound economic transition where the cost of global instability is being directly deducted from your paycheck. The only way to survive and thrive is to stop listening to the generic advice designed for a stable world that no longer exists and start calculating the real math of your own financial reality. I want to hear from you. Look at your expenses over the last few months. What is the real mathematical inflation rate you're experiencing in your daily life? And how is it changing your financial strategy? Leave your numbers in the comments below. If you want to continue decoding the macroeconomic illusions and calculate the real numbers together, make sure to subscribe to the channel today.